Hello, friends, clients, and colleagues. This is Rich Siegel with ARQ Wealth Advisors, and today is Thursday, October 5th, about 4:15 p.m., and it's time for a brief market update. So let's get into it. We'll cover three topics: rates and bonds, economy, and the markets. First and foremost, let's take a look at inflation. You can see that inflation's on a steady climb down from 9.1%. It's in the threes now, which is great improvement. And that's really caused by the Fed's monetary policy of raising rates very aggressively from zero to an unprecedented 5.5% in about a year and a half, fastest rate hiking cycle ever. The good news is that cash is now paying about 5%. We haven't seen that in 17 years. And then on the right side, these are the current yields, these blue diamonds, on various bond investments. Bonds have taken it hard, so I call that some short-term pain for some long-term gain. These gray bands represent 10-year ranges from low to high. For example, the 10-year Treasury was yielding about 0.5% during COVID, and now up to almost 5%. Munis are 7.4%. Investment-grade corporate bonds over 6%, mortgage-backed securities 5.7%, asset-backed bonds almost 6%, and then European debt, corporate debt up almost 5%. So these are the yields that you could expect if you buy 10-year bonds today, locked in for 10 years. So we think bonds are a great value, a better value than stocks are actually. We haven't seen this kind of bond carnage ever. So now they're cheap and they're yielding high levels, the highest in probably almost 20 years. And that's the ideal combination: low prices, high yields on bonds. As far as the economy goes, interesting. Unemployment is still in the threes. The economy is stubbornly strong. In fact, the Atlanta Fed GDP Now model here to the right is showing about a 4.9% GDP forecast for the third quarter, and that will come out, the first version of that comes out on October 26th. It's come down a little bit, but 4.9 is quite high, so much for the near-term recession. However, the conference board, the DC conference board, just basically a data aggregator, is still forecasting somewhere in the first quarter to third quarter, a shallow recession next year in the -1 to -2 range. That's normal. It's good to have economic contractions occasionally, just not economic collapses. So the Fed needs to thread the needle here. Eventually, when they start to see deterioration in the economy, they'll need to start lowering rates fast. That will drive bond prices through the roof. You can see here the layoffs, JOLTS, is increasing here slightly. We were close to 3.4, now we're at 3.7%. Over here, the job openings are cratering. You can see there's over 12 million openings in the country, and now we're down into the 9 range. Every time historically when these numbers have cratered like this, these vertical gray lines are recessions. Now, granted, we're starting from a much higher point, so maybe this comes down further. That said, when openings start to close and when layoffs start to happen, not great for the economy. So we do think we'll still have a shallow recession sometime, probably next year. Equity markets. It seems like it's a good year for stocks, but it's really not. There's only about 7 stocks that are really driving the performance of the S&P 500. Very concentrated. The names, Tesla, NVIDIA. They're trading at almost nosebleed valuations, emblematic of just a couple of years ago, and then they crashed 40%. So great companies, but they're just very expensive. The broader indices are closer to flatline. You can see over here, they were doing quite well, 5-10%. Now you can see the S&P equal weight is flat. The Dow Jones is only up 1.5%. Foreign markets are up 2.3%. In fact, 7 out of the 11 sectors in the S&P 500 are negative on the year. And this is being driven, this recent collapse, because rates keep going up. Rates keep going up because the economy has been surprisingly strong. Okay, so now that we've had this drop in the markets, we are in a kind of oversold condition here. You can see this chart here, moving averages. Going back 5 years or so, every time the averages get below these levels, like you'd see here, the fall of last year, the bottom of the market, then you could see during COVID here, and then you could see we'll call it the Christmas Eve massacre of 2018 here. Every time this tends to happen, buyers come in and try to buy things aggressively on sale. So we would not be surprised to see a nice bounce here in the fourth quarter. Fourth quarter is usually a really good time anyway. August and September are usually the worst, and then the fourth quarter is usually the best. So from a seasonality standpoint, would not be surprised to see some type of rebound here soon. And then lastly, just to look at fundamentals, we look at things from a price standpoint, and this is called a Z-score chart, really pretty slick. This line across the middle is fair value. Anything above the line we can consider expensive. Anything below would be cheap. And you can see here these lighter green diamonds were from the end of 21. The market peaked January 3rd of 22. So the stocks were quite expensive. What got hit the hardest? Large cap stocks right here. Bonds were expensive, right? Rates were low, prices were high. The only real area that was fairly valued was foreign stocks of Europe and Japan. Today, this looks very different. These green dots are as of yesterday, October 4th. What's expensive? S&P 500. Okay, junk bonds, technology, consumer discretionary. What's cheap? Value stocks, financials, industrials, materials, utilities. Small caps are cheap. Emerging markets are cheap. Europe, Japan, Canada, Australia, cheap. Bonds are very cheap. So we like to overweight things that are on sale and underweight things that could crash and that are expensive. So that's kind of our game plan. Again, we do expect a shallow recession sometime next year. The Fed's going to need to act as soon as the economy starts to show signs of contraction. The Fed's going to have to come in and cut rates pretty aggressively, and that's going to be the monetary policy probably for 2024. Thanks for listening. Have a wonderful evening.